Welcome to Investors Insights. Our topic today is topics for a historical day. You heard me right. What a Monday. Actually, the markets are closed. The presidential inauguration is taking place. It is Martin Luther King Day. And for you sports fans out there, we have to throw in the college national championship game will be played later tonight. And with that, we've got a lot of topics to discuss with you on this historical day. So joining me are Bobby Norman, Trey Booth, and Ty Miller. And we've had a fantastic meeting. I thoroughly enjoy, and I say this 1,000 times in this vlog, the debate, the discussions that we have in these meetings. And we like to share the information with you. So in terms of topics, Bobby, I think you've got some good ones. We're going to continue our discussion about Fed rate increases. And also then I think you're going to talk a little bit about energy.
Yeah, so last week we talked about the impact that higher interest rates are having on the stock and the bond market. We're also watching the price of oil going higher. And the price of oil matters because higher oil prices may start to seep into consumer prices, creating an additional headache for the Fed, who is already struggling with sticky inflation. And you can see these two side-by-side charts that oil prices and the 10-year Treasury yield are going higher together. And oil prices, which is the cost of energy, and interest rates, the cost of money, rising at the same time present new risks to the growth of the new year. Obviously, oil prices are approaching $80 as traders work through the implications of tighter sanctions on Russia. So despite the incoming U.S. administration, credibly promising deregulation in the energy sector, geopolitics is again driving oil prices higher. And we've also had 6 straight weeks of drawdowns in U.S. crude stockpiles, contributing to the spike on oil prices, with total crude and oil inventories falling just over 1 million barrels. That marks the lowest level of inventories since September. So this all matters because cheaper energy or a boost to productivity is likely necessary to offset the hit from higher rates. So we're analyzing oil and higher rates going higher in the new year as potential challenges for the market, both stock market and bond market.
You know, Bobby, I know I'm a nerd deep down inside, but when you showed us those charts, I thoroughly enjoyed those charts. They tell us a lot. So I really appreciate you bringing that to the table for discussion today. And then turning to that, Trey, when we started talking about rates, you had some great information as well about Fed rates, maybe Fed rate cuts possibilities, and also housing. Elaborate on that. Talk to us.
Yeah, thanks, Greg. And for those who watch our blogs every week, you'll notice this chart for the mortgage rate is the chart we referred to last Monday. And what it shows is that as the Fed has cut rates, mortgage rates have done nothing but go up. And so we talked about, maybe hopefully economic data like Bobby's talking about, higher cost of oil, higher interest rates may cause the Fed hopefully to pause and stop trying to help bring rates down, because that may help roll over to mortgage rate market, which is something we need. You can see on this chart right here, the market now only expects 1 Fed rate cut in the entire year of 2025. As recently as last October, that number was over 10 rate cuts. So we've come a long way.
Yes.
And this is actually a positive. A lot of people think rate cuts must be a positive, but it's because the economy is so strong that rates are able to stay high. The Fed really can't cut rates. When they cut rates, that boosts demand, which pushes up prices, and we may be fighting inflation again. And so the housing market we'll see a beneficiary of the Fed just pausing, and we'll hopefully see mortgage rates come back down. So that's the demand side. Hopefully interest rates come down to reduce the cost. But on the supply side, we're seeing some positive news as well. This chart will show you the amount of homes for sale this December is 22% higher than the amount of homes for sale last December. So we see a lot more supply on the market, and that has caused the average price of homes to come down by 1.8%. That's not a huge relief, but it's moving in the right direction. A lot of our indicators show that we're not going to see any kind of housing collapse. There's just a supply and demand complete imbalance. We haven't built enough homes in this country, but it's good. The first step is to stop moving higher. The downside is the average home now on the market is $402,000. So not terribly cheap. And then this chart also shows the average estimated monthly mortgage payment. You look at the 30-year mortgage rate multiplied by the average home price, and that gives you the average monthly mortgage. You'll notice that large spike in 2021 and 2022, and then we've kind of leveled off. And so don't expect it to go back down to pre-COVID levels, but a leveling off will absolutely help the consumer take on some of these extra costs that Bobby talked about, higher oil prices, higher interest rates. If we could just see a leveling off here, that would be very good news for the consumer that has dealt with year over year consistent higher cost of the largest purchase they make, which is their home.
Yeah, no, and that's been a topic people have discussed with us all through 2024, and it will continue to be a theme in 2025. So really appreciate your insight on that, Trey. And, at the end of the day, we've talked about, economics and housing and rates and oil prices. We also have to get down to the numbers, the earnings, the revenues. Ty, you brought to the table this morning, looking at that. Update everyone in relation to what Bobby and Trey have said and why we're looking at these numbers.
Yeah, earnings is the lifeblood of the market, so to speak, and so we're getting ready to kick off. We in fact just kicked off fourth quarter earnings season from 2024, and what we're looking at is a comparison here in this chart of where we stood in October to where we are today. So growth estimates right now are expected to be about 9.5% on the earnings side, but that's down from 12% in October. So still solid growth on the earnings side of things. However, you're seeing that being tempered down as we move along here. And then on the sales growth or the revenue growth side, we were almost 5%, and now we're at 4% estimate, 5% back in October, 4% now. And so again, still growing, but it's showing a slowing economy is what we're seeing here. And then, of course, in this chart, it has, projections of every different sector, and you can kind of see how that's filtering through. Earnings, of course, being what the companies in the S&P 500 bring home in profit, and then the sales, just what they're recording, on an everyday basis in sales. And then looking into 2025, what are we kind of expecting? Well, in 2025 right now, the market is expecting about a 13% growth rate in earnings, which would be pretty strong coming off of a good year in 2024. Our internal research partner, Strategas, is expecting something closer to the 10% range. And then with added kind of emphasis on the rate cutting cycle, if the Fed stops cutting rates, as Bobby and Trey have alluded to in the rate environment, seeing these elevated rates, that's going to put a damper on business activity as a whole, possibly. And so while the projections are 13% for the market, for every analyst here, are in the aggregate, and our internal partners predicting 10%, that can certainly come down even more. So again, still growth, but we're starting to see that slowing down of growth. And that's something we're certainly going to be keeping an eye on as we move along here in 2025.
Oh, yeah, definitely. We'll keep an eye on it. And Ty, I really appreciate that. I think it also emphasizes what you were reporting, the amount of data, the numbers that we constantly are keeping up with here at Five Plan Partners in relation to the trends and economic swings that are taking place. And so, folks, just know this, that through this vlog, through our social media, Facebook, Twitter, LinkedIn, YouTube, our podcast, we're going to continue breaking down this information and getting more and more specific with you as we navigate these markets. We're going to keep you updated. And we always want to make sure that we're talking to you whether one-on-one, in person, like this on the WebEx, the Zoom, but also on the phone. And please keep your emails coming to us about potential topics you would like to hear about. We like to know those. A lot of the topics we discussed today were brought up from emails that our clients have sent us. So with that said, we hope you have a great holiday. It's historic today with so much going on, and we're looking forward as we see into the 2025 year, all the different things coming at us, as well as the positive trends that we can benefit from and use in your financial blueprint and strategies in your portfolio. We hope you have a great holiday. Talk to you soon.